Hello, good morning.
Morning, sir.
Yeah,
Morning,
can you all
sir.
hear? Yeah, good morning. Can you all hear me?
Yes, sir.
All right. Apologies for the delay. I was having network issues there, and recall that we actually attempted to hold this class on Thursday, I think. Yeah, and the same thing happened. So let's see. This class is supposed to end in the next, around 9:30. So let's see how far we can go before the end of the class. So, can you still hear me, please?
Yes, sir, we can hear you, sir.
Yes, sir.
All right, okay, all right, very good. So this morning we are looking at, can you see the slides?
Yes, sir.
Yes, sir.
All right, okay, that's very good. So we are looking at the theory of costs this morning. And if we are not able to finish the class, we might likely continue before the week runs out. And I think I should be meeting you on Sunday, hopefully. And yeah, before I forget, please, I give your class, I think the biz admin class and the accounting finance class, a set of questions on, I think it's a manufacturing account. And it is titled Good Luck Jonathan Manufacturing Accounts. So please, I would like you to go through the question and the solution, because I'm going to need it by the time we meet on Sunday. I think that will be done in your makeup class. And so I'm going to discuss that account in detail in relation to this particular topic. So let's look at section 1 of this lecture. Section 1 of this lecture, costs and its horizon. Now, please, can you see the slide very well? Thanks.
Yes, sir.
All right, okay, that's fine. I want to try and enlarge it so that those who are using phone can see the characters properly. Right. So if you cast your mind back to some of the things you did in year 1, I'm very sure you did. These are some of the things you did, maybe in year 1 or maybe during your SSC, but don't worry. I like to start from the very basics before I get to some very complex areas so that students can have a proper understanding of what I'll be discussing with the class. So you have scarcity and its trade-offs. And of course, you know that when we are looking at some core economic concept of cost. And you also have opportunity cost, as well as strategic decisions involving cost. So if you have needs and you have what is known as wants, sometimes it's not what you want that you actually need. So, and there's also there's usually a trade-off between what you want and what you need. Because this revolves around your resources, what you have. I'm talking of the money you have to spend, more or less the disposable incomes at your disposal. So if you want something, it's not necessarily that what you need. So if your economic resources are scarce, and of course, we have what is known in law as necessities, basic necessities. So those basic necessities are actually very important, and it may not necessarily be what you want. Sometimes, let me just give you a very brief example about this. Sometimes you may, of course, when you are hungry, maybe in the morning or in the afternoon or evening. Well, it is important that you eat properly. But sometimes you may have a craving for maybe suya. Suya is not a proper food as far as I'm concerned. But well, it's just one of those things. Well, you know how much suya costs compared to if you go to an eatery and you spend maybe 2,000 naira. You eat properly. But if you go to a malam that says suya, if you really want to buy suya, that you'll be satisfied, you probably will be spending maybe between 3,000 to 4,000 naira. Well, suya is not, well, it's not a proper food as far as I'm concerned. But well, you just want to eat suya, but it's not what the body needs. But again, everything revolves around the resources at your disposal. Please, can you still see the slides?
Yes, sir.
All right. I'm having some issues there. Yeah, okay, that's fine. They're back. And so you also have issues revolving on opportunity cost. We all know what opportunity cost means. You need something, you want to forego a particular need for something that is either important to you or that, well, maybe that's something that you need. And you also have strategic decisions. Companies usually, well, it depends on the size of the company. It could be a one-man business. It could be a small-scale business or industry, and you have large industries that are quoted on the Nigerian Stock Exchange. And again, it depends on the bottom line, the profit they make. It depends on the size of their sales, and of course, if you remember that we have done theory of revenue, and I'm very sure you remember some of those concepts that we dealt with. Of course, if you look at the example of the account I gave you, your profit is usually after deducting your cost. And what you get after deducting your cost, most of the time, of course, you have to deduct tax before you get your net income. So sometimes companies do engage in strategic decisions that will make sure that their bottom line is usually very fine. And this sometimes involves reducing the costs that they have to play around with. For example, the cost of their raw materials, the cost of their cost of sales overall. Let me just put it like that: the cost of sales. So, and if your cost of sales is very high, I'm trying to make you to look at. If you cast your mind back to the account I gave you, the good original account. If your cost of sales is very high, there's every tendency that your profits, depending on the scale of your revenue or sales, will also be very low. So companies, usually manufacturing companies, as much as possible, try to make sure that their cost of sales do not impact too heavily on their sales or revenue. Now let's look at, that is just, I know you some of these concepts. I'm just trying to make sure that we drill down a little bit more. Now let's look at explicit and implicit costs. Explicit costs are usually direct out-of-pocket cash payments made to buy or lease inputs. For example, let's see, I have an example here. I have a case study here. A Lagos case study. You're buying generator, diesel, paying factory workers, and buying cassava tubers for Gary production. We are going to deal extensively with that account. That was the reason why I give that account. And implicit costs are non-monetary opportunity costs that revolve, or let me say, that reflect the value of owned resources. For example, foregoing salary of owners living, for a corporate job, or a foreigner rent from using its own shop, maybe in front of Yaba, whatever. So the implicit cost and explicit costs are different. By the time we meet, of course, we are going to play around with those figures in that account, and you will see the makeup of what an implicit cost is and what an explicit cost is. So let's look at one minute. Now let's look at accounting versus economic profits. There's a reason why I first of all dealt with, or we looked at theory of revenue. Now, accounting profits is different from economic profits. And that's, I would still cast your mind back to the account. Please study that account very, very well, so that by the time we meet, all of us can, be on the same page. Now, you have cost inclusions, primary function, profit calculation, and viability targets. In an accounting framework, only explicit cash outlays are measured when it comes to cost inclusions. And for economic costs, you have both explicit outlays and implicit costs that are measured together. And for primary function, you have audit companies, tax computation, financial reporting. And for economic costs, you have internal strategic planning and resource optimization. For profit calculation on accounting, you have total revenue minus explicit costs only. And for economic cost framework, you have total revenue minus the explicit and implicit costs. In other words, in accounting, the only cost that you remove from your revenue is the explicit cost. And for economic framework, the only cost that you remove from your revenue is the explicit and the implicit costs. I'm going to demonstrate that by the time we meet physically. And for viability target, on accounting framework, you have viable if accounting profits is what? Over 0. And for viability, under economic cost, you have if economic profits is what? Less or equal to 0. That is your normal profits. This accounting and economic profits, we shall deal extensively with it by the time we meet physically. And let's look at the value of normal profits. Under economic profits, when economic profit is exactly 0, the business is making normal profits. And this is not a failure of operation. What it means is that the entrepreneur is fully compensated for all explicit costs and is earning exactly what their capital and labor will yield in their next best alternative business. Don't forget, we just looked at the difference between accounting and economic profits. Now let's look at production time horizons. For every business, you plan for the short term and you also plan for the long term. Usually, in the short run, you plan for you make tactical planning, tactical decisions, and in the long term, you make strategic decisions or strategic planning, and that is usually why the board is there in most companies. Of course, if it's a small company, the board might just be the owner of the business, or maybe the husband, the wife, and then maybe the children. But in a more established business, most of the time you have well, you have the chairman, the managing director, you have executive directors and non-executive directors. So at that level, both the short-term and long-term decision makings are somewhat different. Now, in the short run, in a production, let me say in a manufacturing setup, the production horizon is where at least one factor of input is strictly fixed in quantity. Usually, physical factory sizes, heavy machinery, or these terms involving fixed items, while labor variable remains adaptable. That is in the short run. In the long run, you have strategic planning horizon where all input quantities become variable. In other words, no fixed constraint. In other words, no fixed constraints. And let me say, when you build factories, you have to install alternative production lines or maybe exit a particular market completely. For example, let me give you an example of the company that actually stopped production. That stopped the production of a particular product because that particular product was, probably they felt it wasn't really profitable for them. Okay, let me give you the example of Dangote. I think Dangote used to, before we used to have Dangote flour. At some point, that man discovered that that business was not giving him the scale in terms of profitability that actually fits into his strategic outlook. So, well, at some point, he had to sell the business. And actually, there was a time he tried to do some backward integration, growing wheat or encouraging wheat farmers to grow wheat. But he discovered that it wasn't just working. He had to be importing wheat, and then the problem was probably giving him too much problems. And he discovered that the profit margin was very thin. And so, well, his outlook is completely different. So he sold the business. So in the long run, he discovered that, look, this business is not profitable the way I want it to be profitable. So he sold it. I think he sold it to, maybe Nigerian Flour Industries or which other company there? So to the company. So let's move to short-run cost structures. Here we are going to be deconstructing total, average, and marginal costs under a constrained short-run operating environment. Now let's look at total fixed costs. We are looking at total fixed cost versus total variable cost components. I want to believe that you did some costing in year one. And if you didn't do costing in year one, probably you are doing some costing at this point. Yeah, I think you should be doing some costing at this point. I think. Of course, we all know that there's a difference between total fixed costs and total variable costs. A total fixed cost is a cost that remains completely static regardless of output level. Even paid even at zero output. For example, other commercial office leases, generator assets, purchases, government business licenses. Those are fixed costs, which are total in nature. Now you have total variable costs. These are costs that scale directly alongside changes in output level. Fall to zero if operating costs ceases. For example, hourly profit labor wages, your raw materials or diesel, or fuel burnt per generator per hour. The last time I was in your class, I think I saw that accounting lecturer. I think he was trying to do something very similar to this. So I'm very sure you're very familiar with it. Now let's look at cost formulation, total cost formulation. the total cost relationship. So your total cost is equal to total fixed cost plus your total variable cost. Now, in terms of operations, at zero output, variable costs are zero. In any case, total cost starts exactly at the level of fixed costs. As output increases, the total trend of total cost parallels the upward curve of your variable cost. So put this in mind, your total cost is the total fixed cost plus your total variable cost. If you did costing in year one, I think you should still remember some of the basic relationship. So let's look at short-run unit cost metrics. We have average fixed cost, average variable cost, average total cost. Anything that is average. In other words, if you have your total fixed, if you have your fixed cost in a year, what you need to do is just to deflate it by 2, or whatever the number of months, or maybe number of weeks or hours we are looking at your fixed cost. So that gives you the average. So in other words, this is allocates per hour per unit and must be continually or decreases as production scales up, spreading the fixed overhead over more units. In other words, so your average cost is, assuming you have your fixed cost at the moment, don't forget that it is distributed per unit, or it could be depending on the on what the company is manufacturing. It could be per hour, be on per unit. It could be on well, I think when I meet you physically again, I will discuss what is known as activity costing in detail, and this might come in a bit handy under this lecture. So let's look at average cost. Average cost per unit, usually it is U-shaped due to starting labor cancellation, specialization, followed by diminishing returns. And your average cost, average total cost, is total cost unit of production, also U-shaped, reflecting the combined effects of decreasing average fixed costs and decreasing average variable cost. Now let's look at mathematical unit cost. Let's look at the formulas. These are some of the basic formulas that we are going to need when we meet on Sunday, by the grace of God. Unit cost formulas. Your average total cost, that will be your total cost divided by your quantity. In other words, that is your average fixed cost plus your average variable cost. For individual calculations, to get your breaking it down, you have your average fixed cost, which is total fixed cost divided by the quantity. And you also have your average variable cost, which is total variable cost divided by the quantity of maybe raw materials, could be per hour, or depending on the business that the company is into. Most of the time, if it's a manufacturing company, you use quantity. Now let's look at the concept of marginal cost. The marginal cost, which is depicted as the MC, is the change in total cost resulting from producing one additional unit of output. It is the same principle with what we did under theory of revenue, basically. So your marginal cost is the change in total cost divided by the change in quantity, which results in change in total variable cost. And then deflating by the change in quantity. Now let's look at why fixed costs drop out. Some fixed costs do not change when output varies. In other words, if there's a change in total fixed costs, which equals to 0. So the marginal cost is entirely determined by changes in your variable costs. Marginal cost is the primary metric for pricing and profit optimization decisions. Sometimes, if your production level increases and you try to manage your fixed costs, in other words, if you are not carrying too much fixed costs in your balance sheet, this will actually try to, I would say, reduce. If I want to use a layman's language, I wouldn't like to use too much baboons, so that we can have a very good understanding. So it will start to reduce or drop out. So if your activity level scales up and and let me give you an example. I know of a particular bank. That bank does not buy vehicles for its managers because, of course, a car is a fixed cost. What they do is that they lease vehicles from vehicle sellers. So at the end of every month, they pay what is known as lease rentals. So what they carry in their balance sheet as fixed assets is usually very, very manageable. Let me put it that way. It's not as if they don't have fixed costs in their balance sheet, but they don't spend too much money on fixed assets. So if you have a lot of funds tied down on fixed assets, don't forget that. Well, your fixed costs, there's every probability that your fixed costs will also start to scale up. And so if you manage the level of your fixed costs very well, vis-a-vis your level of production, your fixed costs will start to go down south. In other words, we start to reduce. So I have a case study here that I think everybody can relate with. So let us look at Lagos pure water case study. If you have visited a factory where they produce pure water, it's not a complex business, and I think it's something that that is relatable. The first thing you will see is that, of course, there's no river they get their water from. The first thing they will do is to dig a borehole, and depending on the topology of where the borehole is dug, if you are drilling a borehole in a place like Lekki, you probably need to drill about maybe 400 feet for you to get very clean water. But if you are drilling borehole in somewhere around Ibutemeta, you probably maybe after drilling about maybe 50 feet, because the water table there is quite shallow. And so the cost of digging a borehole in the first place is completely different, miles apart. And then again, you need to buy tank, probably depending on the scale of your production. You need to buy tank. Depends. You can buy maybe 10,000 liter tank or whatever. You need an operating vehicle to distribute the final product, the pure water product. You need to pay for labor costs. Of course, except you want to do it in your backyard. Let us assume that you are renting a space, a small factory. Of course, as the water has been pumped out, you put some chlorine, and then they start to bag it into small sachet water before it is bagged. I think the water bag is probably around maybe it is 20 pieces they put inside. So this is not a particularly complex business. So let's look at it from that point of view. So we can use these costs, looking at this very basic manufacturing company, Lagos, looking at manufacturing pure water. So let's map out this cost formulas using a total concept of sachet stroke pure water packaging factory operating in Lagos. So the business we face leasing, fees on packaging, equipment, and variable inputs, including electricity, water purification, treatment chemicals, and plastic rolls. So if you like, you can just visit a pure water factory and see what they do there. And so this is hello, can you all hear me?
Yes, sir, we can.
All right, okay. I have 2 minutes left for this class. So apparently, I'm very sorry for starting late. There were network issues. So because I have 2 minutes left, I don't know, I'm probably going to stop here, and I will give you another time and date within a week that I'm going to conclude this lecture. So I'm going to start from this pure water case study. That is where I'm going to start from. And I'll conclude it when next we meet. So it's unfortunate that we didn't start on time. I want us to conclude this lecture before we meet over the weekend so that we can do some number crunching. And please remember the Good Lord Jonathan manufacturing account that I give you. Please bring it to the lecture. In fact, just print it off. I wouldn't want you to be looking at it on your phone. So just print it off. I think it's about maybe two, three pages. That is less than 100 naira. So bring it to the lecture so that all of us can look at it. That is what I will use to actually explain this lecture in detail, so that all of us will have a very good and better understanding. And I think on that note, I want to end this lecture. We are on, I will start from slide number 14. The pure water sachet business. I would drill down a little bit more, and then we'll conclude this lecture. Then we see on Sunday. So on that note, thank you very much for listening, and I wish you a very nice weekend. Thank you very much.
Thank you. Bye-bye, sir.
Thank you.
Thank you,
Bye-bye.
sir.
Yeah,
I
bye.
appreciate you.
All right. Thank you.
Please send us your slides, sir.
All right, I will. I will. But if I send it now, you will not attend the lecture when I meet you again. But I will send it, don't worry.
Thank you, sir.
All right, I will send it. I will send it. Don't worry. Don't worry, I'll send it.
Thank you, sir.